Money FM 89.3, best of the breakfast huddle. The Bigger Picture with Ryan Huang.
Money FM 89.3. You're in the breakfast huddle here with Elliot Danko, Manisha Tank and Ryan Huang. It is time for the bigger picture. And one thing that people may find surprising is despite Singapore's resilience during this pandemic, the STI is not getting much of a boost.
It is not. In fact, it's underwater by around 20%. And very interesting when you look at how markets such as what's happening on Wall Street is making new highs since March. And of course, this is reflective of how the index is rather different. You've got tech names in the US, but back here in Singapore, it's mainly made up of REITs and banks. And that's one reason why the Singapore market is not for passive investors. And that's going to our next guest, Wong Kon Hao. He is the Managing Director for Waypedia, and he specializes in the study of market psychology, and he is an investment strategist. Morning, Kon Hao. How are you doing?
Hi, Ryan. How are you?
Hey, Kon Hao, let's talk about passive investing. I think about passive investing as just buying and keeping for a long time. How well does it work for Singapore markets?
Maybe I just give you a perspective of how SDI performed over the last 10 years, since 2010 to today. So SDI generally is trading in the range between 2005 and 3005. Now, in between this 10 years, there were 3 cycles, each lasting about 3 to 4 years. And all these is within 1,000 points, 2005 and about 3005. Now, I would advocate for Singapore market with such a phenomenal, let's be an actively passive investor instead. This means that we can hold for long term, but acknowledge the cycle and manage it. The opportunity comes every 3 to 4 years. I still remember, I think that was about 2 years ago in April 2018, that we have a conversation about SDI interesting phenomenon that we recognized that over the last 10 years or 8 years then, there was a 1,000 point range. And that was the peak. Then the market was in April 2018, it was trading at the peak of closer to the peak about 3,004. And today, 2.5 years later, we are seeing that SDI is hovering around 2005. I felt that opportunity is pretty near, not immediate, but how I position myself is that it's the time for me to start accumulating good stock right now into the future.
Yeah, so from the sounds of it, it sounds like it has been quite range-bound. It's been trading sideways. So does this mean the buy and hold approach is not as relevant as it was maybe in Warren Buffett's time?
Well, we have to understand the nature of each market we're investing in before putting a time frame to it, how long we're supposed to hold each market. Now, let me give you an example between Singapore and the U.S. market. Now, for example, the STI is composition, like what you said earlier. Mainly, they are made of banking and property stocks. Just the index alone, banking and property stocks is 60% or more. Now, I would classify these as old economy. So, therefore, we saw this phenomenal, a range bound of 1,000 points up, 1,000 points up and 1,000 points down over the last 10 years. But I believe that this is about to change. So, now let's go to the U.S. market. And now for the U.S. market, since the 70s, they have entered into a fiat currency system. This means that they can technically print unlimited amount of money, and at the same period, crude oil was sold in U.S. dollars for the first time. And U.S. dollars became our world reserve currency. Now, the rally started in the 80s, and it has lasted for 10 years. So there's a difference between Singapore market cycle and the U.S. market cycle. Now, having said that, U.S. or rather Singapore market, we have this phenomenon of 1,000 points. It may not be a bad thing, though. Although it's an old economy, this means that when the market move up, it will not move up a lot because we have not many tech stocks around that we have, or heavy-weighted tech stocks. But similarly, when the market came off, is making a correction, the downside will be quite limited as well.
Yeah, so it sounds like it's a bit of a different market for different investors, someone who's after more resilience and maybe even dividends if you are thinking about Singapore markets. We are chatting with Wong Kon Hao. He is the managing director for Waypedia. Kon Hao, talk to us about what being an active investor entails. How often do you have to check the markets? How often do you have to move your portfolio?
Yes, you're right. So we have to be constantly looking out for changes, not just in Singapore market. I think we're quite blessed to be in Singapore, being a Singapore investor or invest in Singapore. Why? Because Singapore, it is a financial hub. Being a financial hub, it means that for the investor or traders, we are free to invest not just local market, but overseas market. Now, the key is be constantly looking out for changes around the world. Now, it works both ways when we recognize changes. It helps us to manage our risks and opportunities as well.
And what is the appropriate time to keep regularly reviewing your portfolio? Is it every 3 months or is it every month? What is the type of review process like for you?
Well, it really depends on individual investor that how savvy and how serious you are. But if you're in the notion of I want to be a passive investor and you have the thoughts that I like a stock and if I buy a stock, I want to hold it forever and I don't care at all. And I think that's not the right attitude in investment. We have to, even you want to function in that mode, I would still advocate that every month you still have to check out the stocks that invest in the countries, the macro economy. Every month you have to do that. The stocks that you're investing in. While looking at the global market trend throughout, being a retail investor, say for example, I will look out every month. At the end of the month, I will look out at any significant changes that's happening right now before it's too late. Before I make the switches.
And Kon Hao, just to wrap things up, right now there's so much volatility with what's going on right now. You've got Brexit, you've got the US elections coming up. So how do investors manage the potential unexpected drastic downside risks that could be around the corner?
Well, like I said earlier, we have to look out for changes. Let me just give you an example right now, because I understand that a lot of our friends will tell us that, well, look at history. Over the last 100 years, it has been going up. So U.S. market will always go up. I think that's a very irresponsible statement. In fact, the U.S. market only started to go up in the 80s until today for the last 40 years. But since about 1910 all the way to 1980, U.S. market has been hovering around 2005, just like Singapore right now. So if you study into the long-term history chart of U.S. Market, from 1910 all the way to 1980, it has been around 2005. So it was a very challenging period for the U.S. market then. It only started to experience a major bull trend since 1980. Now, for example, you asked me the last question there was, I'm looking out for divergence, say for example. So now, it is true that U.S. market historically has been going up, but what happened to the past, the result that was happened in the past, does not guarantee the future. I'm always very concerned about that. So I'm constantly looking for divergence. Say for example, fundamentally, what's the divergence right now in U.S. is that, the Wall Street and the Main Street, it doesn't match up. The Wall Street has been going up, but the Main Street, the retail, the shops, the business have been suffering. So whenever I see a divergence, I would have to be, I'm still bullish about U.S. market, but I'm extremely cautious right now to manage my risk. And technically, for those that are in charge, you could look for, you could literally look at, see a divergence comparing between the price and the indicators. Yeah.
Okay, so look out for divergence and anything that could affect your investment thesis or initial theories. I've been chatting with Wong Kon Hao. He's the managing director for Waypedia. Kon Hao, thank you so much for your time this morning.
Thank you, Ryan. Thank you.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at moneyfm893.sg or download the SPH radio app available on Google Play or the App Store.